This is Tim. Tim would like to invest some money, but the problem is that Tim doesn't really know much about investments. What should Tim do? Well, Tim could try buying stock funds, but with the current state of our economy, he could lose a lot of money. Tim could also try to buy some bond funds, but he is afraid that the rate of return would be too low. So, what should Tim do? Well, the best option for Tim would be to invest into a mutual fund.
Slow down, heart of the new year, brought down by gravity crystal clear.
A mutual fund is just a connecting bridge that allows a group of investors to pool their money together with a predetermined investment objective. The mutual fund will have a fund manager, called a portfolio manager, who is responsible for investing the gathered money into specific securities, stocks, bonds, or liquidity. When you invest in a mutual fund, you are buying units or portions of the mutual fund, and thus, on investing, become a shareholder or unit holder of the fund.
This is how it works. With your mutual fund, you get a portfolio manager who makes all the important decisions for you. This is a professional that knows everything there is to know about investments. The portfolio manager pools your money with the money of his other clients into the mutual fund and spreads the money of the fund into the most profitable investments, differentiating between equity, debt, liquid, and hybrid funds, which is the process of diversification. This way, the investors benefit no matter the shenanigans of Wall Street or other economic blunders. Because it is very well spread out, it is assured that there will be little to no loss, even at the economy's worst. The pluses of mutual funds. Professional management. Who would manage your money better? You, who may have no experience or in detail knowledge of the market, or a professional who spent close to a decade learning everything there is to know about the markets and then spent years working with other clients similar to you. Portfolio diversification. With mutual funds, you can usually invest in 25 to 100 securities or more. Diversifying your money increases the chances of you getting a larger payoff with much lower risk. It also ensures that you get a profit from any number of securities. Cost efficiency. Mutual funds are a cheaper, more communal way of getting your investment work done. It costs less than trading individual securities on your own, and they have reasonable investment minimums. Mutual funds can be opened with as little as $100. Safety. Mutual fund industry is a part of a well-regulated investment environment where the interests of the investors are protected by the regulator. All funds are registered to the government and complete transparency is forced. However, as with everything, there are some disadvantages. First, there are fees. Tim will have to pay investment management fees and fund distribution costs as a percentage of the value of his investments as long as he holds the units, irrespective of the performance of the fund. There are no customized portfolios. The portfolio of securities in which a fund invests is a decision taken by the portfolio manager, not by Tim. Tim has no right to interfere in the decision-making process of his portfolio manager, which some investors find is a constraint in achieving their financial objectives. Money is in the hands of another. You have to have complete trust in your portfolio manager. If he makes a mistake, it'll be your loss. Your investment could be spread out too thinly. Sometimes portfolio managers can spread the investments too thinly, decreasing the possible profit on return.
There are at least 4 types of mutual funds: equity funds, money market funds, debt funds. Basically, equity funds are advisable for long-term and generally aimed at providing comparatively high returns than the other funds, but with a relatively higher of risk as they only invest in stock. In contrast, debt funds are invested into fixed income-bearing instruments such as bonds, government securities, and certificates of deposit. Therefore, debt funds are also called income funds, as they are not that risky and provide a stable income, but less profit to the investor. And there are the money market funds that are liquid funds invested in short term, maturing within 1 year. These securities are highly liquid and provide safety of investment, thus making money market or liquid funds the safest investment option when compared with other mutual fund types. And last but not least, there are the hybrid funds for people who are both cautious and aggressive at the same time. They consist of a balance of equity, debt, and liquid funds.
Comparing to stocks and bonds. When you buy a share of stock, you can make money through dividends or through the capital appreciation of the stock over time. By comparison, when you buy shares of a mutual fund, you are buying a share of a portfolio of securities. Many mutual funds hold millions of shares of stock in their portfolios, and they are managed by professionals with expertise in financial markets. While mutual fund prices rise and fall, this risk is spread more than when buying individual stocks, and you have what amounts to an instant portfolio managed by a professional fund manager. If you are buying individual bonds, you must open an account with a bond broker. This typically requires an initial investment of several $1,000s. By comparison, you can get involved with mutual funds for a much smaller initial investment. Pricing and evaluating bonds is a bit confusing for the average investor. Evaluating the bond rating of each company and then determining when to buy and sell these bonds is difficult. Investing in mutual funds allows you to leave these calculations and decisions up to your portfolio manager. When you buy individual bonds, each one has a specific life. When a bond matures, you must replace it with another bond to continue investing. Mutual funds have an indefinite lifespan that is always replenished with new bonds. But wait! Tim only has $300 to invest. Is that enough to invest in a mutual fund? Yes. Some investment organizations like TD Bank, for instance, allow you to invest as little as $100 per fund for their TD mutual funds. The costs of mutual funds differ with each investment organization. For instance, the minimum initial investment for TD mutual funds for both non-registered accounts and RSP accounts are $100 per fund. The fees depend on the investment level, starting from 0.71% per fund from the initial investment. Additional place you can buy a mutual fund from is Franklin Templeton Investments. Their investments start from $500 per fund, and fees begin from 1.6% per fund. And the rate of return would depend on what types of securities Tim's portfolio manager chooses to invest in. Most money market funds have an average yield of about 0.34%. Equity funds have an average net assets value, or NAV, of about negative $31.06. Debt funds have an average NAV of about $17.64, and hybrid funds have an average NAV of about $3.65.
Now that Tim knows what he wants to do, Tim is happy.